I've been trading for more than 15 years, and in this video I'm sharing the 13 best and my absolute most favorite price action signals, strategies, tips and tricks that I have come to learn over the last few years. Also, I've prepared a few goodies, so if you want to learn more about my trading, my strategies, or just check out all the resources that I'm offering, then make sure to check the link in the video description below. And now let's get started. One very important price action signal or just a concept is the so-called fakie, and some people may refer to it as bull traps, bear traps, failed breakouts. And technically what you want to do is you look for either long-term support and resistance levels or short-term resistance levels or just single swings, and what you want to look for is a rejection of the level. And ideally you want to see that the candle and the market is piercing through whatever level that you have identified, and then within one candle, within two candles, very quickly reversing back and rejecting the level. You typically don't want to see a breakout, although there are cases where it can enhance the setup. If, for example, like here, you have actually a close above a high, and then within the next candle, you have a very strong reversal candle. But let's focus on what we're seeing here, and you can see that the market is in a very strong downtrend, and then we are reaching the previous support level. And what is going to happen here? A lot of traders who are short are probably going to take profits, which is contributing to bullish pressure. Also, a lot of breakout traders are probably getting into here, so selling more. Probably the people who have been missing a lot of those trending action here are then trying to get in short here. Their stops will be somewhere here, and then as the market reverses and is rejecting the level, the stops are triggered, and a stop on a short position is also going to contribute to buying pressure. So you'll often see that the market is playing around those previous lows and highs. There can be more than one rejection, and typically what you would like to see then is a momentum candle. Here you can see after the pin bar, then we'll have a momentum candle. The momentum candle also has a component of the pin bar, so we take out the lows once again, which is a very, very strong signal, a double takeout of a low, and then the same candle has also the momentum here in form of a engulfing candlestick. So it's completely outside of the past 1, 2, 3 candlesticks. So a very, very strong reaction. The market did move a lot in this candle, and it closed almost all the way at the high. The final piece to the puzzle, if you're then looking for a bullish move away from the level, you could wait for the market to actually clear the so-called flip zone. Previous support may be holding as resistance here. So you want to make sure that you don't get in under a resistance level. So you could wait for the market to actually get above this level and then initiate your long entry. And you can see the market in the candle afterwards closed above the long level. Here we have another rejection, which is another stop run. And then you can see afterwards the market is really nicely taking off. Second, I love the breakout buildup. I talked about this a few times in the past. I think it's a very, very great pattern. It's also a component that you can use for any other pattern, so it can be considered an add-on. So what we have here is the market is in a strong uptrend. You can see from the bottom left to here, we are making higher highs and higher lows. Then the market hits a resistance level here, and we are seeing a bearish move. The bearish move does not break the last swing low, so we are not technically violating the uptrending structure, which is good. So we are still technically overall in an uptrend. And then the market returns to the previous resistance. But the most important thing is how the market is then reacting after reaching the highs. And you can see, whereas the first time we reached this high, the market sold off very, very strongly. It is, in fact, the strongest sell-off that we are seeing here in all of this uptrend. But the next time the market is reaching the level, there's just barely a move. The market is very closely staying here at the highs. And this, what does it indicate? It indicates a lot of buying pressure. It doesn't indicate a lot of selling interest anymore. Probably there was already a lot of buying interest, and when the market dipped here, the buyers got in here. And the most accumulation probably happened here at the last swing low. Then here, there is not more selling left. There's very, very little selling left. And then you can see the build-up. The market is really sticking to the level. However, we definitely always need to wait for the market to clear the high. So the final piece to this setup and the final piece to the puzzle here is you wait for a confirmed close above this level. Here you can see that we have a close and then we have a retest. So breakout and retest often come very close together, and then the market takes off. The dirty retest is a liquidity concept. I talked about this in the past, and it's a very, very important concept. Even if you don't end up trading the dirty retest, understanding about stop zones, liquidity zones, and stop runs is very helpful for your stop placement or just for general chart understanding. So what do we have here? We have the market in a downtrend, then we have the so-called triple tap, tap 1, tap 2, tap 3, which is a pattern that I will cover later in this video as well. And then we are building this pattern, which kind of looks like an inverse head and shoulder. We have here our neckline, the right shoulder, which is a higher low. The left shoulder, probably somewhere in here. We also have the component of a double bottom. And also you could say maybe this, the right shoulder of a head and shoulders sometimes also has the concept of a breakout buildup included. And what happens now? The market is breaking out, and a lot of breakout traders are probably getting into around here. Their stop is, depending on their style, somewhere in here. On the breakout, their stop loss may be about below the recent low, maybe below the absolute low, or maybe just very close if you're an aggressive trader. So the market takes off, and what are people going to do? They are going to move their stop loss to break even because they want to protect their stop loss, or so they think, or rather they want to protect their trade, or so they think. However, stop runs occur very frequently, and it's so obvious right now. Where are the stops going to be? They are going to be break even, they're going to be here, somewhere in this area. And what happens to free up liquidity? The smart money, the big players, are going to drive the price back into the zone. First of all, now we are just fishing for the real break-even stops, which are just here. And on the next push, we're going to get deeper and deeper until we find the real liquidity pockets. And then once we found the liquidity pockets around here, you can see how fast is the market retracing. Every time we hit a liquidity pocket, you see strong bullish impact. And that is the key. When you see that on the dip back into the pattern, you see afterwards a very strong bullish reaction, such as here or here, very huge candles. That shows you that there's a lot of buying going on, a lot of stops are being triggered here, and also probably a lot of people are going to get into the trade. You could then wait for the final piece, which is here. We have established a resistance level, and then once we get above it, you can see that's where potential entries could have been taken. But it's always important to ask yourself, where would other traders have their stop loss, and will they move it to break even, yes or no? And then just react on when the market is coming back to a previous breakout area, for example. How's the market reacting? Do you see strong buying going on? Then that is a very good hint. Flags are a very classic pattern, but if you read any of the classic price action books or books about technical analysis, they often reference flags as one of the most profitable patterns. And flags are trend continuation patterns. So what you do is you look for the overall trend direction. So clearly we are coming here in a downtrend from the top left, and the market is moving lower. And as we have talked about in the past, trends just don't move in one single line to the target. They go back and forth. And the flag pattern is going to help us to get into trend trades. Maybe we have missed the initial move of the trend, or maybe we want to add to our existing position. So what happens is you see that the trend direction is downwards. In a very short time, the market falls. And then we have a flag. The flag is the so-called consolidation. And the market moves up. It is going against the ongoing trend direction. One thing that is often common for a flag is that the angle is much shallower than the trend. So here you can see we fall very strongly in a short amount of time. So the angle is very steep. Whereas here, the angle is not as steep. It's not very aggressive buying. And that distinction and the difference between how strong is the buying versus how strong is the selling is also helping us understand, okay, this is actually or could be a potential flag consolidation. And on the breakout, we may go lower and resume the trend. What you don't want to see is a very strong flag pattern. So if the market rises very strongly, that's often not a very good sign, because it indicates actually either a lot of buying or a lot of profit taking from the sellers. And you can see after the flag was broken, we moved down very, very quickly. So you can see in a long amount of time, the market rose very little. Whereas here in a short amount of time, just a few candles, less than 10 candles, the market not only broke below the flag, but we continue to move lower. Then here we don't have a typical flag, but we have another consolidation. And here the market was not even able to go higher. Here we were just able to make equal highs. So whereas here in the initial flag we did have some upwards momentum, here the buyers absolutely had no say over the market. And there were only sellers, probably a few sellers getting out, more sellers getting in at the top. And then you can see the breakout candle, very, very strong. And then we resume. And again, when we resume, that is where the market moves a lot. Whereas in these consolidations, there's barely any movement. Triple tap, one of my favorite patterns. It's a very, very important pattern to note. And the triple tap can help you understand when are trends likely to end and to be over. And ideally, you want to look for a triple tap in an existing trend. So if the market has been trending for a long time and then you see a triple tap, that's where you want to really get interested. And basically, the triple tap just means 3 consecutive higher highs. However, each high is less and less strong. So we can see that the market was very strongly rising higher. And then from here to here, the market barely was able to make a higher high. So that's already indicating a very weak market. Then from here to here, first of all, it took a very long time. Whereas in the trend, you typically don't see that the market takes so much time to move higher. Also, the distance is very long, or very short here. From here to here, there's a very, very small amount that the market was only able to push higher. So this indicates weakness, a lot of weakness in a strong uptrend. Then you can see afterwards we have a lower high. So here the market was not even able to make or get above this high. So a very, very important additional piece to the puzzle. We see here, then the market is breaking the lows of the previous uptrend, and that's where the market really collapses. So the triple tap is the first sign, the lower high is the second sign, and then on the breakout, that's usually where breakout traders and trend reversal traders get in. Price divergences, they're kind of similar to triple taps. They just focus on a few other concepts, or we could say they focus on the same thing, but we're looking at it differently. So we're looking here at a downtrend, obviously, and we can see the downtrend was moving down here very, very quickly and strongly. There was almost no bullish opposition, right? The market just moved down. And then here suddenly we have a strong buying period. So the market moved higher, which it has never done during the past downtrend. So what happened here? Probably a lot of profit taking, people who were short, who got out of their trades, they're locked in the profits. And then maybe a few people who maybe missed the trade or the trend then got in here on the next leg. But what happens? The next leg here seems to be much shorter. Whereas here the market trended lower for a long time. Then here, for now, we don't see a lot of trending going on. And when we look ahead, you can see we are skipping ahead a little bit. And you can see very strong selling, then strong buying, which is something you don't want to see. And then a very short amount of time of selling only. So we cannot even compare this period down here. Maybe, how much is it? Maybe a fourth of what happened here. So a fourth only of the selling duration here. So there was not a lot of interest in selling. That's the point here. Not a lot of people wanted to sell after we got here. And then the market started to completely reverse and made higher highs and higher lows until it reached this point. So now we have really shifted our bias. I wouldn't say when we look at the market in this way, it doesn't look bearish anymore, right? I wouldn't say it looks really bullish either. It's more like a transition. We are going from downtrend to sideways range. So the market is in a transition period. It is between trending legs. And then the final piece to the puzzle is you would like to wait for the market to clear here this area. And what does this mean? It would mean